The Federal Reserve today announced its plan to help stimulate the economy. The plan is to buy $40 billion worth of mortgage bonds a month until further notice. This whole idea has been dubbed QE3. The hope is that this will bolster the economy and generate jobs. This after Fed watchers have been ramping up pressure for the central bank to take more aggressive steps to strengthen the economy. But will this method work? To weigh in, our financial guru, Lauren Lisser, host of Capital Account, joins us now. Lauren, great to have you here. So QE3, it's called this because it's the third time around they're trying to do this. What makes this time different?
There are a few things that make this different. So you're calling this QE3 for good reason, but you might want to call this QE infinity or QE until further notice, because unlike what the Fed has done in the past, where it said, okay, we're going to buy this amount of treasuries or mortgage-backed securities, and we're going to start on this date and we're going to end on this date. What's different this time is the Fed saying we're going to buy $40 billion in mortgage-backed securities a month, and we're going to do this until we decide not to. And Ben Bernanke, in his statements today and in the Fed's press release, said that this is going to continue until the labor market gets to where they want it and improves significantly. But there's no set timeline. So that's what really makes it different this time. Also, the Fed is targeting mortgage-backed securities, so it's obviously trying to target the mortgage market and the housing market there by directing it specifically to mortgage-backed securities as opposed to treasuries, government bonds, which would monetize the debt. So those are a couple differences in terms of what exactly the Fed's program is. Also, the Fed, some changes. It said that it'll keep a very accommodative monetary policy until even after the economy improves, so that even when things get better, they're still going to keep this accommodative policy, and they gave forward guidance for interest rates, which have been kept near zero for years. They said that's likely to continue until mid-2015. So they extended that to Liz, which basically kills the price mechanism in this country and destroys the ability of the market to understand the price of money and the price of risk, because the Fed is distorting it.
Interesting. You had mentioned Bernanke. Let's take a listen to what he had to say today about this.
To purchase additional agency mortgage-backed securities, or MBS, significant progress at a pace of $40 billion per month. The new MBS purchases, combined with the existing maturity extension program and the continued reinvestment of principal payments from agency debt and agency MBS already on our balance sheet, will result in an increase in our holdings of longer-term securities of about $85 billion each month for the remainder of the year. The program of MBS purchases should increase the downward pressure on long-term interest rates more generally, but also on mortgage rates specifically, which should provide further support for the housing sector by encouraging home purchases and refinancing.
So there he is, Ben Bernanke himself, almost describing it as a last resort, touting the possible benefits of this program. What do you think about his remarks?
What I think about, well, that was a fancy way of saying kind of what I was saying. The thing about this QE is that not a lot of people think that it's going to work to help the real economy. So he was talking about expanding the Fed's balance sheet, about $85 billion on the long end per month. The Fed has expanded its balance sheet more than $2 trillion since the financial crisis. It's used that balance sheet in order to try to stimulate the economy. And where was unemployment, Liz? Above 8%. Where is unemployment after these measures? It's still above 8%. So what is doing more of the same going to do to bring down the unemployment rate, which is what this is targeting? So what Ben Bernanke is hoping there is that he's going to go out and he's going to prop up asset prices, and maybe that'll be in houses, and maybe that'll be in stocks, and that people will feel richer. So when they feel richer, they'll go out and they'll spend their money. So there will be more demand for products and for services, and that this will amount to growth and that this will create jobs. Now that is the thinking. Maybe some would call it wishful thinking, because there's a difference in people that believe that the problem with unemployment is cyclical, meaning what Bernanke said, that growth is weak and that if the economy's better and demand is spurred, then the jobs will come. But there there's another camp that believe that these problems are structural, meaning people have the wrong skills for the jobs that are available, or that the jobs that have been lost aren't coming back and people need to be retrained, which is a totally different issue. So that's just one of the concerns that comes up for me. Meanwhile, there are many unintended consequences from printing money, from expanding the Fed's balance sheet. We don't know how the Fed is going to unwind that. These policies are unprecedented. Their measures are inflationary. Their measures debase the dollar. They debase the currency that you and I use to buy things that affects our purchasing power. And for savers, for people on fixed income, they just totally get hosed because interest rates are at zero. They keep being suppressed. They're already at record lows. So that means you're not making any money on your money. People can't save.
And so essentially, as you're saying, basically what this does is it floods the economy with new money. And if this is the third time around, I mean, why keep doing something and hope for new results?
Well, that's the definition of insanity, I believe, someone very famous once said. But you ask a really good question. You bring up a really good point. I want to bring up a chart that might help illustrate why the Fed keeps doing this, because there is an argument to be made, Liz, that the stock market is addicted to easy money. Take a look at this. So here you can see the little boxes that denote essentially when QE programs were announced and begun, and then when they ended. And what you can see is when they're announced and begin, the stock market rises, reacts positively, and then the market knows when those programs are ending. And when they do, the stock market falls again until another program is hinted at or begins. So the market loves easy money. It's become addicted. And so the Fed gave the markets what it wanted, the drug that it wanted so much. But what it did this time that's slightly different is it said, we're not going to tell you when the drug is going to run out. We're just going to keep giving you monthly doses until we decide not to. So you can't front run us and you can't discount the Fed. So that's a little different. But markets are addicted. So there's an argument to be made that
so it
this
sounds
is meant to prop
like
them up.
it's more of a short-term solution than a long-term one.
I mean, you could argue it's not any kind of solution, which is the argument that I would make. This is supposed to be a free market economy in the United States, and you have the Fed that decides the price of money, keeping interest rates at zero, making money that cheap. And that distorts things, Liz. That distorts the prices people pay, the investments people make, and the signals are all off. And the credit that it's trying to create isn't getting out to the real economy, which is trying to help. If mortgage rates are so low, well, what does that do for someone if they can't afford a monthly payment for a house because they don't have a job, or they don't make enough money, or their credit is shot from the last housing bust? So these are all issues that no amount of easy money can dispel.
Really interesting. And lastly, I want to ask you, earlier you said that there is no timeline. I mean, how long can they keep this up?
It's a great question. I don't know. Liz, your guess is as good as mine. Ben Bernanke won't tell us. So we don't know that. But we do know that one effect of this, okay, in this QE, the Fed is buying mortgage-backed securities. So it's not directly monetizing government debt, which is what it would be doing by buying treasuries, which it has in past quantitative easing episodes. But interest rates are at record lows. And so who pays that interest? Well, who gets to borrow at that rate? The U.S. government. So there's an argument to be made, and David Stockman, Reagan's former budget director, has made this very clearly, saying that this essentially enables the government to not have to address spending, to not have to address these big moneyed interests in Washington that are dependent on government spending to the tune of so much money, like the military-industrial complex, because the government can borrow at these record low rates, so they don't have to pay the piper yet, because once those interest rates go up, once the government has an exact case, if we want to play it for the audience.
They'll never do it if you can keep borrowing free money forever,
right,
because the Fed and these lunatics who are running it, and I use that word advisedly, are basically telling the whole world untruths about the cost of money, about the cost of risk, about how you allocate
You wonder
capital.
why we get the,
So you're saying they'll never do it. They'll never take on these issues with spending. They'll never take on the moneyed interest while the Fed has interest rates and the price of money so distorted.
Really interesting, Lauren.
It is.
I appreciate you coming here into the studio. That was Lauren Lister, host of Capital Account.
Thanks, Liz.